Welcome to this explainer. We're going to take those dense, kind of headache-inducing accounting formulas and transform them into streamlined, totally automated business systems. If you've ever felt, bogged down by manual number crunching, you're definitely in the right place. Today, we're unlocking the true power of spreadsheets to really explain the core concepts of this chapter. We'll be taking complex periodic business math and turning it into something elegant, efficient, and honestly, just a breeze to use.
Okay, let's take a quick look at our roadmap for today. We're covering the spreadsheet advantage, the anatomy of a payroll, automating the paycheck, tracking asset depreciation, and finally, calculating depreciation systems.
Let's jump right into Section 1, the spreadsheet advantage.
Moving on to Section 2, anatomy of a payroll. So think of every paycheck as basically a financial tug of war. On one side, pulling the number up, you have the earnings, things like basic wages and allowances. But on the other side, you've got deductions, pulling that total right back down. These are your statutory requirements like the provident fund and taxes, or maybe personal deductions like loan recoveries.
To build our spreadsheet accurately, we first have to sort through this absolute alphabet soup of earnings components. It's never just salary, right? It's basic pay, or BP. It's grade pay, which obviously changes based on your role. Then you have DA, the dearness allowance, which is specifically there to compensate for the erosion of purchasing power when prices go up. Throw in house rent allowance, HRA, and transport allowance, TRA, and, well, you get the idea. Each one is a totally distinct variable we've got to handle.
The crucial point here is that all of those moving parts, every single earning and deduction, they're all driving toward one vital number, the net salary. It's simple math at the end of the day. Take total earnings, subtract total deductions, and you get the exact amount hitting the employee's bank account. That's the ultimate destination of our payroll engine.
All right, Section 3, automating the paycheck. Let's see how we actually build this thing.
Putting this engine together requires a really logical step-by-step progression. First up, we program the spreadsheet to figure out the effective days present. That's basically the days in the month minus any unpaid leave. Step 2 uses those days to compute the basic pay earned. For Step 3, we aggregate all those fancy allowances we just talked about into total earnings. And finally, Step 4 knocks out the total deductions. It's literally a perfect repeatable sequence. Now, to make the spreadsheet run completely on autopilot, we have to feed it specific logic rules. So, instead of manually calculating every single employee's allowances by hand, which, no thank you, we just give the spreadsheet the exact percentage rates. We tell it, hey, dearness allowance is 35% of basic pay. House rent allowance for supervisory staff, make that 40%. And we lock in the provident fund deduction at a strict 12% of basic pay plus dearness allowance.
And this right here brings us to a massive game changer, using absolute cell references. By slapping dollar signs around a cell address, like literally typing $G, $3, we lock those percentage rules permanently in place. This is huge because it means we can write the formula once, drag it down a column of, say, 500 employees, and the formula will always point back to that exact same percentage rate. It doesn't shift. It's an incredible time saver.
So when we actually fire up this first engine, here's how it plays out for a sample company, XYZ Enterprises. At the top, you've got those absolute reference rules we just set up, like the 35% DA. And below that, pure automation. The spreadsheet takes the effective days, calculates the basic pay earned, and just seamlessly adds in all those varying allowances to spit out the total earnings. And it does this perfectly whether the employee is supervisory or non-supervisory.
And the magic just continues right across that exact same template. The spreadsheet perfectly aggregates the provident fund, tax deductions at source, any loan installments, you name it. It sums them up into a total deduction column, and boom, auto-generates the final net salary for everyone. What used to take hours of mind-numbing manual arithmetic is now done literally the second you punch in the attendance days.
Let's pivot to Section 4, tracking asset depreciation.
Any solid organization has to rigorously track the cost of long-term resources that get consumed over time. We're talking about tangible physical things like plant machinery, vehicles, and buildings. But it also includes intangible assets that add value, like goodwill. Oh, and here's a fun fact. Depreciation is generally not provided on freehold land. Why? Because land basically doesn't lose its value over time.
Now, before we can even think about programming a spreadsheet to calculate depreciation, we have to pin down a really critical term, salvage value.
This is essentially the estimated scrap value, the amount the organization can realistically sell the asset for at the very end of its useful life. It's absolutely crucial we know this because we only want to depreciate the value that's actually lost over the years, not the value we're going to get back at the end.
Section 5. Calculating depreciation systems. Let's look at the math.
When it comes to accounting policy, usually guided by frameworks like the Companies Act, you're generally looking at one of two methods. First is the straight line method, or SLM. This one's super straightforward. It distributes the loss of value evenly across every single year of the asset's life. The second is the written down value method, WDV, often called the declining balance method. This one hits you with higher depreciation in the early years and then tapers off over time based on the asset's declining book value.
If you were to build the straight line formula the old-school manual way, it takes a bit of work. First, you have to calculate the total acquisition cost. Keep in mind, that's not just the sticker price. It includes transportation, installation, and pre-operating expenses. From that grand total, you subtract your salvage value to get your total depreciable amount. And then finally, you divide that amount by the asset's expected useful life in years.
But here is the absolute beauty of spreadsheets. They completely bypass all that manual fractional math and condense the entire straight line method into a single built-in function, equals SLN. That's it. You just feed it the cost, the salvage value, and the life, and the software handles the rest.
Let's look at an actual asset template to see this in practice. The spreadsheet neatly tracks the purchase dates, but more importantly, it aggregates all those costs, the purchase price, installation, pre-op expenses, into one master cost to use column. So for a piece of equipment, like a CNC machine, you can clearly see how its base cost bumps up once you add in the installation and pre-op fees to find its true starting value.
And here is the final payoff. By simply referencing that cost to use we just figured out, along with a salvage value of $45,000 and a 7-year life, the SLN function goes to work. It instantly generates the exact depreciation amount, roughly $120,000 in this case, for that CNC machine. No complex math required on your end.
Now, what if your company's accounting policy strictly requires the written down value method instead? No problem. The spreadsheet adapts instantly. You literally just swap out the SLN function for the DB function, which stands for declining balance. You feed it the exact same initial cost, salvage, and period data, and it automatically runs that complex declining balance formula for you behind the scenes.
Seeing how easily tedious payroll tracking and complicated asset math can be transformed into these robust automated systems, it's just incredibly powerful. By mastering a few absolute references and built-in functions, you're making the spreadsheet do all the heavy lifting. Which leaves us with one final thought to wrap up this chapter explainer. What manual, repetitive calculations are slowing down your business today, just waiting to be automated? Thanks so much for joining me, and I really hope you use these concepts to build some incredible engines of your own.